Hi everyone. Today I'm talking about digital assets and mergers and acquisitions. The convergence of market momentum and policy changes in the United States, as well as investor demand, are going to drive activity in the digital asset sector for the foreseeable future, and mergers and acquisitions is one significant way that that's going to happen. My name is Joe Castelluccio. I'm a partner at Mayer Brown. It's a global law firm. I co-lead our firm's financial services, mergers and acquisitions practice. I also co-lead our fintech and digital assets practices globally. So I'm talking about this convergence today because it not only sits at the intersection of two things that I spend a lot of time doing, but also because we will increasingly see the convergence of these two things play out in digital assets markets and the broader financial services markets. Today we're going to be talking about a few things. First, I'll tell you some things that I hope you'll get out of this presentation. Next, we're going to talk about maybe why you should care about this if it's not readily apparent. Then we're going to talk a little bit about the U.S.'s first crypto election. I think by any objective measure, it's safe to call it that. And then I'm going to talk about four key storylines that you'll want to keep an eye out for and the ways that digital assets and mergers and acquisitions will converge in the coming 12 to 18 months. So first, why are we talking about this? We're talking about this because blockchain and digital assets present a once-in-a-generation evolution in financial services technologies, financial markets, and cross-border money flows. There have been years of growth and significant advancements, even despite an uncertain regulatory environment in the U.S. But with the results of the U.S. election in November, as well as some significant steps that have happened in the United States, both in markets and in government in just the first few weeks of the second Trump administration, these will catalyze a massive amount of growth in digital assets, products and services, and crypto assets as investments. Banks and other traditional financial businesses will develop and evolve blockchain and digital asset strategies that complement their businesses and allow them to compete in these changing markets. There is definitely no one-size-fits-all approach. And both traditional financial services as well as the crypto sector are not homogeneous. There's a lot of nuance, there's a lot of subsectors within those, and we'll get into a little bit about the different ways that those markets will evolve in those different subsectors. I hope this presentation is useful in understanding both the market landscape and introducing concepts that, if you're in this space or want to get in this space, that can be incorporated into an effective digital assets and blockchain strategy. So next, why are we talking about this? I think we're a long way away from, I'll say, some of the early crypto winners, but I don't think it's an exaggeration to say that some still may view crypto as a passing fad or nonsense, or maybe some other less polite ways to put it. I don't think it's an exaggeration to say that blockchain technology and digital assets, I said evolution, I think revolution may be a better way to put it. And I give as an example, not too long ago, to be honest, there was a significant amount of sector of the population and markets that thought that the internet may have been a passing fad or only for those that wanted to money launder or engage in arms trafficking or other things like that. This is a real headline from not that long ago. And we've got some other examples on the screen of similar evolutions or revolutions in financial services and fintech over the past 60 or 70 years. There was a time, again, not too long ago when financial markets, stock markets would close for an entire day just so that the exchanges could catch up on paperwork. So the revolution of being able to trade securities and record those transactions digitally at first gave people a lot of pause as well. And here we are many years later, we don't even think about it and couldn't imagine doing it another way. So some other examples here, including e-payments and e-commerce, that have really become a daily part of our lives. I don't think it's an exaggeration to say that blockchain and digital assets going out 5 and certainly 10 years from now, we'll be looking at this in a very similar way. So a quick primer on what this stuff is. That will be the subject of a whole nother video that I encourage you to watch. But for the time being, what I'll say is blockchain and distributed ledger technology more generally really is just a different flavor of an ice cream that we're all really familiar with. You might log into a bank account, a credit card account, through an app or the web, and you go to a central gatekeeper, a central repository of information about your financial life, how much money you own, how many securities you own, etc. And if you want to do a transaction through one of those intermediaries, that's the way you do it. You log in through a password. Those gatekeepers are both the repository of information, they're responsible for the security and accuracy of that information as well. And the diagram here on the left shows, again, in very simple terms, transactions that we do all the time, and we're all really familiar with. Now, on the other side, we've got the distributed ledger model. You still have records of who owns what. I can use Bitcoin as an example. The Bitcoin blockchain is a record of transactions that have taken place in that since its inception. Instead of having one central repository for those records sit in copy on all the nodes or all the computers that are linked to this network. And that's the diagram that's shown here. And again, in another presentation, I can get into a little bit more about how those records get recorded, how transactions happen. But for the time being, understand that it's a type of technology, it's software. It's used for specific purposes, just like other types of software in a centralized or other contexts. And one other thing to keep in mind, despite some headlines and I think some justified skepticism of certain things, coins and tokens are not tulips or not merely speculative things with no inherent value. That's a much bigger debate, and hopefully most of you get the tulip reference. For those of you that don't, you can look up the tulip craze of the 16th or 17th century in Holland. For the time being, this is the extent of the sense of humor that I'll bring to this video. Skip ahead. As we've seen over a number of years, even again, given an evolving and perhaps slowly evolving regulatory situation throughout the world, some of the largest financial institutions of the world have embraced digital distributed ledger technology and blockchains to transact in money markets, in securities markets, and many other ways. More recently, traditional finance companies and digital native companies that have grown to scale are increasingly rolling out digital assets, products, and services that both increase speed and efficiency in transactions, but also meet tremendous consumer and market demand. So why are we talking about this now? Especially because these events and these developments have been happening over a number of years. I don't think it's an exaggeration to say that the November 2024 elections in the United States, federal elections, both for president and Congress, could easily be called the U.S.'s first crypto election. There's lots of reasons for that, and I think focusing on the net effect of it, having the current Trump administration as well as the current configuration of Congress really has led in just a few short weeks to a sea change in approach and outlook for digital assets, products, services, and markets in the United States. We've got some policy objectives here for the second Trump administration, some of which have already been put into place. We have a repeal of a controversial I'll call it a rule, a staff accounting bulletin from the SEC that had the effect of largely keeping many financial institutions out of certain areas of digital asset services. We have replacements in waiting in leadership for a number of significant agencies that have jurisdiction over digital assets. And just last week, we had an executive order issued by the Trump administration, which was extremely wide-ranging, extremely positive for the industry, and a 180-degree turn from the prior administration and the outlook of federal regulators in the U.S. Generally on digital assets. There's a lot to digest there, and candidly, it will take some time for a lot of those policy objectives to play out. Some of them, again, have happened relatively quickly with some early decision-making and action being taken by the SEC. Others, including the federal legislation on the market structure approach to digital assets, that will take some time and need to work its way through Congress. So with that brief backdrop, I want to jump into 4 key storylines that will be shaping the way that digital assets, products, and services evolve in the market in the near future, and ways that transactions involving digital assets or digital assets businesses will play a significant role in how those markets develop. So there's lots of storylines we could talk about, and I'll cover each of these in brief in this presentation. Check back with us later for more detailed discussion and how these storylines and others develop. The first is there's been a convergence, and there will continue to be a convergence of traditional finance and digital assets or blockchain infrastructure, products, and services. That convergence has been going on for a number of years. In some cases, some of those traditional finance companies have been building and develop things almost in stealth mode, and now as regulations and markets develop, they'll be in a position to roll those things out quickly. For other traditional finance companies, they may be further behind in the building phase, so they may be looking to accelerate what they're doing, possibly through mergers or acquisitions or other types of investments. And that's storyline number 2. Storyline number 3, crypto assets, I would say are emerging, I think have emerged as a legitimate alternative asset class, both for institutional and high net worth investors, as well as retail investors. Fourth, stablecoins are becoming a legitimate and widely used financial product with growing assets under management and an increasing number of use cases, which go along with revenue generating opportunities for financial institutions. So kicking off with storyline number 1, traditional finance is increasingly adopting and integrating blockchain technology throughout its product and service life cycles. There are lots of reasons for that. Speed, efficiency, cost savings, consumer demand among them. Digital assets and crypto products are also an increasing focus by investors, and I'll get to that when I get to storyline number 3. In the US, these trends will accelerate. It says here, if the policies and regulations are reformed as anticipated. I think some of those reforms have already started to take place. Others will take longer to play out, but I think it's very safe to say that we're in a much different environment from a regulatory standpoint in the US than we were just a few months ago. I'll talk more about regulations in a bit. As a result of this convergence and this market momentum and these policy and regulatory changes, most financial services institutions will require a blockchain and digital asset strategy that is integrated in its operations and activities. As I said before, similar to the way that other historical digital transformations have happened in financial markets. Now, under the Biden administration, the positions of numerous U.S. financial services regulators had the effect of significantly restricting what banks and other financial institutions were able to do. Revisions to crypto policy by the Trump administration, changes to key agency personnel will be part of that change in approach. And in just the last few months of 2024, even before the election, there had been some movement in markets to roll out these products and services as demand really increased, notwithstanding any change in regulatory positions. As these policy changes, as these regulations evolve and get updated, there will be greater opportunities for financial institutions to offer digital assets, products, and services. For example, in areas like custody of crypto assets, tokenization of real-world assets, facilitating customer purchases and sales, loans that are collateralized by digital assets, and as I mentioned earlier, stable coins and payments generally involving crypto assets. Just one case study among many, many that are in the market is BlackRock's launch of its first tokenized fund issued on a public blockchain. The Institutional Digital Liquidity Fund, or BUIDL. It's pegged to the US dollar. It offers monthly dividends to investors. It invests 100% of its assets in a series of high-quality, stable reserves. And importantly, this tokenized fund has been and is being used by a number of different investors as collateral for crypto derivatives and similar types of transactions, and an order of magnitude in the trillions already. Some key risks and challenges to developing financial products in this space: the regulatory uncertainty that continues to exist. And I'll pause here for a second. I've been focusing on U.S. federal regulations and laws relating to digital assets. Those are expected to evolve in varying forms as agencies headed by Trump appointees start to update rules and positions. If we get either stablecoin legislation or broader market structure legislation, again at the federal level, that will have a significant impact on how digital assets are regulated. But significantly, we still have a 50-state system in the United States, and there are several fairly powerful and influential state regulators, including in New York and California, that have historically had jurisdiction over certain digital assets activities, and that will continue. So there's an overlap, and in some cases there may evolve to be a conflict between a federal approach and a state approach, and it will be important to carefully watch how that interaction of state and federal laws plays out. From an operational standpoint, how you integrate technology into the operations of a traditional bank, a traditional financial institution, is particularly tricky. In some cases, operational capabilities far exceed what can be done from a regulatory standpoint. So that tension between what is technologically possible and what is regulatorily permissible is something to navigate very carefully, and something where, frankly, advisors and others that have a good understanding of both the technological capability as well as the regulatory situation in the U.S. and outside the U.S. Will be particularly important. Moving to storyline number 2. The regulatory and policy changes that I described, as well as a maturing market and increased customer demand, will result in increased M&A activity. That's increases in the volume of M&A deals in all their forms, as well as, I believe, increases in valuation as demand for businesses that fill a hole in a market, meet consumer demand, will become even greater demand. And we've already seen significant digital assets M&A activity in the market. That's both from traditional businesses seeking a foothold in the sector, and also from crypto native businesses and players looking to expand and scale. To date, one of the largest transactions of this kind was Stripe's acquisition of Bridge, which was a transaction announced in late 2024, valuation north of $1 billion, and which closed just this week. Policy changes and regulatory changes, again, will cause this trend to accelerate. As both traditional financial institutions and other incumbent players, payments companies, etc., they will look to accelerate their entry into markets where they feel they need to in order to compete and to meet customer demand. And on the other hand, you've got crypto native and digital assets firms that have been growing despite these regulatory challenges in the U.S. They now become much more attractive targets for established companies that are aiming to enhance or expand their crypto and digital assets products and services. And as the regulatory landscape in the U.S. shifts, cross-border M&A will increasingly become a viable path for this type of growth through deals with businesses that to date have operated and grown outside the U.S. because of the regulatory approach here. And there are many different types of M&A deals that could occur. There's many different types of digital assets and crypto asset products and services. I wanted to highlight 5 key areas where we've seen M&A activity before, and because of consumer demand, we can expect to see increases in those. The first is in asset management. I mentioned earlier, as investors, not just retail, but institutional and high net worth investors, as they continue to look to crypto assets as a viable alternative asset class, asset management in this space and people that have a track record of performance and an investment strategy will increasingly become attractive Two examples here on the screen, including Coinbase's acquisition of what would become Coinbase Digital Asset Management back in 2023. Next is custody. This was the subject of the Staff Accounting Bulletin 121 issued by the SEC. It largely prevented many banks and financial institutions from custodying crypto assets. As that has fallen away, we can expect to see custody as a service being increasing demand from customers. Stablecoins and payments, as you can see here, the example I gave earlier. I'll speak about stablecoins again in a few minutes. Digital asset infrastructure is another category, and I want to focus here on the first one on the screen, DTCC's acquisition of Securrency back in 2023. You might remember I had DTCC on the screen in one of my earlier slides. It was formed back in the early 70s as one of the early conduits through which electronic securities trading took place and was cleared and recorded. So the fact that they, even a couple of years ago, made a significant investment in a blockchain infrastructure company, in other words, using blockchain as the rails, so to speak, or the behind-the-scenes means through which securities transactions are recorded, I think is particularly meaningful. Next, we have exchanges. This is one of the types of crypto businesses that I think many people are probably familiar with. Coinbase is obviously a very prominent one. There have been others, and we'll continue to see financial services companies of all varieties looking to provide a platform for their customers to trade these crypto assets as volumes of those trades increase significantly. And when I say M&A generally, or mergers and acquisitions generally, they can include transactions of with a lot of different structures, a lot of different varieties. They come in a lot of different shapes and sizes. Partnerships or investments made by one company into another, joint ventures, things like that are all fit into this category of M&A or transactions generally. And we have a few prominent names here from what I'll call traditional finance, entering into these partnerships, developing these products and services, and bringing them to the market. And when doing an M&A transaction of any kind in this space, risks and challenges, but also opportunities. Identifying a viable digital asset product and service that complements the overall strategy of the business is really key. And I know I'm speaking as a lawyer, but that goes well outside legal considerations to really core business ones. There can be a bit of FOMO. There can be a rush to catch up or to compete with competitors. But there's a lot of M&A transactions that don't succeed ultimately because they're not consistent with an overall strategy. They're not integrated well, and some of that planning in advance isn't done. Along the same lines, risk assessment and post-closing integration is particularly important. This is especially true if the acquisition target has not been subject to stringent or any regulatory requirements in the past. Integrating those into, say, a traditional financial services company or a bank that has very strict standards for regulatory compliance and a host of different laws that they need to comply with, that clash in culture sometimes can be challenging. One of the ways your advisors can help you through this process is by learning from their experiences and mistakes that they've seen made, both assessing legal risk as well as business risk in specific areas that are both critical to any type of finance business, as well as those that are unique to a crypto or digital assets business. Number 3, I mentioned crypto assets as, I'll call them a legitimate alternative asset class. I think traditional asset managers, and more importantly, their institutional clients, are increasingly looking for exposure to crypto assets as an asset class. As a group, they're generally non-correlated to most other asset classes, with potential for outsized return as well as corresponding risk, and can be extremely volatile. And that's in an investment environment where alpha is increasingly hard to find. Alpha or returns beyond a benchmark, or what you would get by simply investing in a basket of large cap stocks. There's been a number of products that have come to market already. Many of you probably know about the spot Bitcoin ETFs that have been out in the US for about a year. Coinbase recently released an index for tracking certain crypto assets. And again, as investor demand continues to increase, we can expect to see more or a greater proliferation of those types of investment strategies. Just to put some colors and numbers to this trend in one very narrow sense, 11 spot Bitcoin ETFs were approved back in January of 2024, and you can see the rate of market adoption here for those in just a very short period of time. Just one headline that I thought was amusing, and all credit to Bernstein for writing it. This was shortly after the U.S. election. This is not investment advice by any stretch of the imagination, but I think it speaks to the overall zeitgeist of the market right now and where investors see opportunity. And you already have traditional finance seeking exposure to these as well, notwithstanding that there are regulations that prohibit certain types of financial services businesses from owning crypto assets outright. There are a number of different financial instruments that allow exposure to this asset class. And there were some publicly available statistics from the CFTC on trading in crypto derivatives that took place in the lead up to the election. Some pretty large numbers there put up in paper profits by a small number of financial institutions. That's just one example that speaks to the opportunity that has already been moving and already being seized in the market. And I think combine that with some of the other dynamics I mentioned, we're likely to see that accelerate and continue. A few risks and challenges for this storyline. Structuring these crypto asset products or strategies to balance market demand and risk management requirements. Disclosure is also another hot topic in any type of securities transaction or investment strategy. There's also valuation challenges in partnerships between traditional asset managers and crypto asset managers. There are ways to mitigate some of those risks. That's including regulatory analysis both onshore in the US and offshore. Unlike most types of stocks or other securities, crypto assets trade often on a global basis on multiple different exchanges 24 hours a day. That's both a market opportunity and challenge, but also a regulatory challenge. How you structure these partnerships or how you structure these transactions is an important part of transactions among traditional asset managers, and those considerations are present in deals involving crypto asset managers as well. Things like whether you structure it as an acquisition, a minority investment, a revenue sharing agreement, or something similar. There's a number of different factors that go into that, and carefully navigating that is something an advisor can help you with. Last storyline is stablecoins. As recently as yesterday, today's February 5th, Senator Hagerty and 3 other senators released the latest draft stablecoin bill titled the Genius Act. There's a lot to unpack there, and I think it's safe to say that as a draft will go through a lot of discussion, a lot of negotiation, and probably some changes before it's finally debated and voted on. But it's an indication of how stablecoins as a particular type of digital asset, people believe is both a good opportunity to get some regulatory updates, some regulatory clarity. It also speaks to the demand in the market for stablecoins. I think right now, the overall worldwide market cap for all stablecoins is well north of 200 billion. And I've read a statistic recently that says that increases roughly 100 million every day. Stablecoins are an interesting product with a variety of use cases. By linking or pegging the stablecoin, the digital asset, to a more stable reference asset like the US dollar, stablecoin can be used in scenarios where price stability is a primary objective and important, such as cross-border payments, on-chain trading, as well as collateralized lending. And we've seen, again, explosive growth in these products in just the past couple of years. Just a few examples on the screen, some almost household names at this point, including Tether's USDT and Circle's USDC. PayPal USD was launched in 2024, And there are numerous other examples of stablecoins that are either in process, in development, winding their way through a regulatory approval process, or otherwise in the process of being brought to the market. As I mentioned, in the last Congress, there were 3 different bills proposed that related to stablecoins. They had some common characteristics, but a few, I'll say, different approaches as well. The current bill that's pending, again, may not be the last one proposed. There are people that believe that stablecoin legislation will be easier to get done in the grand scheme of things, given that it's a relatively narrow topic. And there's been a lot of work done on what the regulatory structure would look like with respect to them. But like any process in Washington, it's likely to take time and may have some unexpected turns while it happens. So a few key takeaways and risks and challenges in respect of stablecoins. I mentioned earlier the dual regulatory system in the United States, federal versus state. That is currently present with respect to stablecoins. And even if you look at the most recently proposed bill, there is a dual regulatory structure built into that. There still remains some enforcement uncertainty, although I think it's safe to say that enforcement against crypto asset businesses and crypto asset products generally is going to look a lot different under the Trump administration than it did under the Biden administration. Another important consideration for stablecoins is their possible usage to evade sanctions or to otherwise allow people to engage in illegal transactions. That's both a sanctions as well as a national security concern that is present throughout a lot of the discussion on how to appropriately regulate these types of assets. And with that, I'll say thank you for listening. If you do have any questions, I'd be happy to hear from you. This is definitely one of the most exciting things I've done throughout my almost 25 years working in financial markets. It's exciting, and I'm even more excited to see what comes in just the next 12 months. So thank you again for listening.